So that's one solution, and it's been working. I've been using it for 8 years, and I'm happy to talk about it afterwards. But let's talk about one more structure that I've just started using that's totally different in terms, it feels like it's within the paradigm, but it's not. And so it's called permanent capital. And it has a very, very strange look on my graph here. You put in money to a company, nothing happens. There's no promises, and nothing will ever happen with that money ever in terms of this picture. But there's a reason to do this. So the fundamental ideas inside of this other solution is that ownership should be perpetual, or ownership is perpetual. Right? So when you buy equity if you buy land, it's your land forever. Right? No one takes it from you. If you buy shares in a public company, you own shares in a public company for hundreds of years unless they go out of business or get purchased. So what if investments were forever? What if the idea was that you were going to put money in a company and that company was going to last forever and your investment was going to last forever? When you start down that path, you start to think about separating what the investors want and their timeline from what the company wants and their timeline. So typically investors want some money back, right? They want a return on investment. And startups, when you talk to most startups, most entrepreneurs in the world, they don't want to be acquired. That's the California idea. There are entrepreneurs that want that, but far more entrepreneurs, 90-something% of all entrepreneurs in the world, want to build something that lasts. And so why are we taking this short-term thinking from the VCs and mapping it on top of entrepreneurs that don't want it? That's silly. So again, going down this rabbit hole here, well, why do we even want the ROI? We want the ROI because we want money, because we like to be able to say that we have the most money when we die, when in fact it's the most value when you died, or the most value you have when you're not dead, or while you're still alive, that really matters. So what if we start thinking about how you build out a valuable portfolio that's permanent, that's perpetual? All right, and if you do this, then you can stop thinking about exits totally. I'm not buying a company because they might get sold in 10 years. I'm not buying a company because they're going to go and do an IPO in 10 years. I'm buying a company because I think they're a good company, and I would love to see what happens to them in the next 100 years. It's very different. I've never heard of that in any investing community I've ever been in. All right, so here's an example. Here's a real world example out of my life on what this means. All right, so Fledge is my accelerator, and we invested in 105 startups so far, 27 countries, lots of places. And we've been using revenue-based equity for that. Specifically, in this case, we did 27 investments in Africa, all in the food and ag industry, right? Plus others, right? There's another, was that 70 more companies around the world, but there's 27 in food and ag. And our goal, what we told our investors that we would do with their money is return, 2x or more. And we told them it would take 10 years. It might take 12 or 15, because successful VC funds actually take 12 or 15. But we promised them a 2x return. We promised that these companies would buy us out. All the stuff I just told you about in the last half. All right. So what do we do? What do we do to make that happen? Well, we brought these companies through an accelerator. We provide them advice. We introduce them to funders all the time. We talk to them about how they grow their revenues, because we get paid on revenues. And ultimately, we want to not own these companies, right? Which is the aim of every VC, not to own companies. Now, here's what we've done in the middle of a pandemic. We've instead taken these 27 companies specifically, right? All of them have gone through a Fledge program somewhere. And we took them out of Fledge and we swapped all that ownership from Fledge to this new thing called AfricaEats, which is a holding company. It is a permanent, perpetual investment holding company. So what does AfricaEats do that's different than Fledge? Well, it will fund the companies. We already started doing this. We're out looking for more money. We're funneling money through the holding company to these 27 entities. We're still advising them. We're still focused on revenue growth because that's a measure of success. But now we're not looking at revenue growth in terms of how fast can they grow so they can pay us back. We're just looking at how fast can they grow given the resources we have. How fast can they grow given the resources of the team? if they're done growing, that's fine. They can just tell us that. We'll stop funding them. We can just make they're almost all profitable. They can keep running. We're totally happy with that. They can grow as big as they want. We will help them do that. And the oddity here, the difference is that we're not looking for the companies to get acquired or go IPO. We're looking for the holding company, for AfricaEats, to go public in the mid 2020s. We intend for AfricaEats to still own these companies in 2100 and 2200 and 2300, the year 2100. Like 100 years from now, if we don't own these 27 companies and more, and they're not all running, we'll be disappointed. Right? We want to own these companies forever. We like them. So once we had that mindset, the question is, what else can you do? And so once we have this mindset of, well, these are our companies, we're going to own them forever. And we're minority stake owners. We don't control these companies. They have founders. We're just helping those founders grow. Right? We own no more than a third of these companies. So we want to help them grow. We want to support them, and we want them to support each other, because they're now all connected through this holding company. So this is a graph of what we did. It looks like a total mess and a little bit of modern art, but this is what it looks like. It's 27 founders across 27 companies. And so we've connected them. We've officially connected them on board of directors, where they're serving on each other's boards and helping each other, and they're looking for synergies, and they're providing up to the little team that runs this company ideas on how we can serve them better. We're rolling out solar power next month because they need it. And as a VC, that seems like a crazy thing to do. It's like we should find them a solar lender, is something I would do with my Fledge hat on. But as the AfricaEats CEO, it's like, no, forget that. Well, let's just do it. We will just put in solar on their buildings because it's useful for the next 20, 30, 40 years, right? It will pay for itself. And we'll just have them buy it out at, let's say, 0% interest, because it's best for everyone if we don't extract too much money out of these companies. So let's do it at 0% interest leases. So we're rolling that out in the next week or two. It's a very, very different model. I love this model. It's awesome. I hope there's many, many copycats of this. I can't find another one that's doing this in the same way we are. It's not a new model. We didn't make it up. There's a few things in here that we're doing that I haven't seen elsewhere, but the idea of a permanent holdco, well, it's been done for a long time. Berkshire Hathaway, it's this isn't accurate anymore, but it's close. 1, 2, 3, 4, 5. I think it's the 6th or 7th most valuable company in the United States, public company, in the United States. Right. So back in 2017, it was worth $500 billion. It's a little bit more than that now. What is it? It is a holding company. They own companies. This is a picture of the companies they own. To pick one out here that most people around the world probably know is Duracell. Duracell is not an independent company. It is a subsidiary of Berkshire Hathaway. It was purchased a long time ago by Warren Buffett's company. It was purchased by Warren Buffett's Berkshire Hathaway, 100%. It's 100% owned by this company, by Berkshire Hathaway. It's run by a separate management team. It's run as if it were an independent company. Berkshire Hathaway is kind of it's the holding company, owns it. It provides them with whatever they need to grow, but it's just one more of the companies in here. There's a candy company. There's a company that makes underpants and t-shirts. This is a railroad. This is an insurance company. These guys make floors. There's a lot of companies in here. And then they own some public companies too. They own some pieces of public companies. And that first venture capital fund I was talking about, American Research and Development, back in 40-something, that this guy started, George Durrell. It was, in fact, structured as a permanent capital holding company. It was a public company. Any American could invest in American Research and Development. They could buy shares today. They could sell them tomorrow if they didn't like it anymore. They could sell them whenever they wanted. That's that separation between the timeline of investors and the timeline of startups. So the timeline of investors, it varies from investor to investor. So when you get to be a public holding company, which we aim to do, all of a sudden the investment can come in whenever it makes sense for the investor, and they can leave whenever they want. Right? It's public shares. They can sell them, 9 to 4 most days of the week, depending on the market. And then more investors can come in later. And so it's very, very different. It's a very different paradigm. So I'll leave you with we'll have a few minutes for questions here, but I'll leave you again with this book, which I highly recommend everybody reads about paradigms, and two more books. The one on the left exists; you can go buy it. It has more details. The one on the right at the moment is just a cover. I want another few years of experience before I write up how to actually do it. But it made the cover. I have a lot of books, and that is my story about California capitalism.